All right, welcome to the Explainer. Today, we are diving deep. We're going to build a professional-grade framework for how to handle your risk when the market is basically running on fear. So let's get right into it. Okay, let's just rip the Band-Aid off. As of March 30th, the overall market sentiment is, you guessed it, negative. Now, we are seeing a few brave souls out there bottom fishing, but the dominant mood, it's caution. It's risk off. It's everyone heading for the sidelines. And that, of course, leads us to the big question, the one we're here to answer today. When the headlines are screaming and assets are flying all over the place, what is the disciplined professional response? How do you act when your gut is telling you to just react? That's the framework we're going to build. To figure out how to act, we first have to understand why the market is so on edge. And believe me, the story right now starts on the geopolitical front line. That is the #1 driver of all this uncertainty. So hotspot number one is the, chaotic situation around the Iran peace talks. It is a really complex, kind of confusing approach from the U.S. administration. On one hand, they're saying, hey, serious negotiations are happening. But on the other hand, they're issuing some pretty severe threats. And look, these are not vague diplomatic threats. The directness of the specific quote, it just shows you the gravity of the situation. It totally explains why the oil markets are freaking out. This isn't just talk. It's a risk that is being priced in as a very real possibility. You know, as if the whole situation in the Strait of Hormuz wasn't enough to worry about, a brand new threat has just entered the chat. Houthi forces in Yemen have launched their first attacks, and that introduces a critical new risk: the potential shutdown of the Bab el-Mandeb Strait. And this right here, this is the nightmare scenario for global shipping. It's not about just one choke point anymore. Think about it. The Strait of Hormuz is the main artery for Gulf oil, and the Bab el-Mandeb is the front door to the Indian Ocean. If you get a double closure at the same time, wow. As one source put it, that would just dramatically amplify an already bad global shipping crisis. The key takeaway here is that two totally separate threats are now converging on the world's energy supply. And here it is. Here is the immediate, real-world impact of all that fear. West Texas Intermediate crude oil just surged over 5%, blasting past $105 a barrel. See? This isn't some abstract risk on a map. It is hitting the most critical commodity on the planet, right now. Now, with that geopolitical mess as a backdrop, you'd probably expect a simple risk-off story, right? Everybody sells everything. But the data? It's way more tangled and honestly, pretty contradictory. So let's untangle it together. Okay, this is the key puzzle that has all the professionals scratching their heads. Normally, falling interest rates are like candy for the stock market. But on this particular day, they both went down. Why? It points to a really deep conflict happening inside the market's brain. This table pretty much tells the whole story. On one side of the ring, you've got crude oil and gold rallying on clear geopolitical risk. That's a classic flight to safety. But then look at the 10-year Treasury yield. It actually fell because Fed Chair Powell said some calming things. Normally, that would send stocks soaring, but it didn't. The takeaway is that the market is literally fighting itself. It's terrified of geopolitics, but it's being soothed on interest rates at the exact same time. And even inside the stock market, you have this huge split. The tech-heavy NASDAQ, it took the biggest hit, down almost 0.75%. The broader S&P 500 was down too, but then look at the Dow Jones, it actually squeaked out a tiny little gain. This is not a market that's moving together. So what is happening here? It's a classic K-shaped rotation. Think about the letter K. One arm goes up, one arm goes down. The high-flying tech stocks in the NASDAQ are super sensitive to economic fears, so they went down. Meanwhile, the Dow, with its old-school value and energy companies, was actually lifted up by that surge in oil prices. It's a clear split between growth and value. Okay, so we've diagnosed the problem. It's geopolitical fear creating a tangled, contradictory, K-shaped market. So now let's pivot from what's happening to what we do about it. What is the professional's next move? Well, it requires a structured, disciplined framework. And this is the absolute foundational philosophy. In a market like this, our impulsive, emotional, System 1 brain is just screaming. Either panic sell everything or get FOMO on the first green candle you see. The professional approach is to just tell that voice to be quiet and instead use a deliberate System 2 process where the market's actual fear level becomes your North Star. And that leads us to the single most important rule in this framework, the IV primacy principle. Sounds kind of fancy, right? It's actually super simple. IV, or implied volatility, is measured by the VIX. The source material is crystal clear on this. When the VIX is above 30, you are in the fear zone. And the rule is simple. You do not aggressively add new risk until that fear gauge comes back down to earth. Period. So what does this actually look like in practice? Let's walk through this decision table. First up, adding new stock positions. Nope, suspended. VIX is too high. What about holding your existing energy positions like XLE? Yeah, continue. The geopolitical risk that's driving it is still very much in play. Holding defenses? Yes, you want that buffer. Maintaining your long-term core holdings like Microsoft? Absolutely. The long-term AI story is not affected by this short-term noise. And finally, hold cash? Yes, recommended. You want to stay flexible. So within this weird environment, the source material points to a few key assets you should really keep on your radar. You've got Walmart, which is a big winner in a K-shaped economy where people are looking for value. You've got Bitcoin, which actually showed some relative strength and is starting to look like an alternative safe haven. And of course, you've got gold and the energy sector, which are the most direct ways to hedge against the big risks we've been talking about. Now here's the kicker. This whole fragile situation could get totally flipped on its head by the end of the week. We've got jobs data coming out, but really, all eyes are on one single report, Friday's March non-farm payrolls. That one number has the power to either calm all these fears about the economy or pour gasoline on the fire. And that leaves us with the final and most critical question. The framework is in place. We know the key data point we're all waiting for. So the question isn't, what should I do right now? The question is, how will I react to the new information? After that report on Friday, what is your strategy? That's the difference between reactive emotion and professional execution.